Now stocks are holding on to their gains. Nasdaq still at 2.5%, and Nvidia is leading the way on pace for its biggest gains since February, up 11.5%. Still, it's down about 7% in July, and a number of factors are leading to today's big gain. A rebound after yesterday's decline, plus positive comments from Morgan Stanley. Also, AMD reporting its results and slightly beating estimates for earnings and revenue, and showing continued growth in sales for AI chips. Those shares are up 3%.
And that is where Microsoft comes in, even though the stock is trading lower after its results. The street loving the $19 billion of spending, almost all of it on AI. Melius analyst Ben writes this, calling it the CapEx that saved the world. He says that all that Microsoft money will benefit Nvidia and AMD, but also Broadcom, Arista, and even Intel.
And oil prices, meantime, are higher 4% today after concerns about fighting in the Middle East escalating could lead to a regional war. Hamas's top political leader was assassinated in Iran. Iran is accusing Israel, and Iran's leader is threatening Israel with, quote, severe punishment. Israel has not commented on the assassination, but did say it killed a Hezbollah official in Beirut, whom Israel blames for the attack over the weekend that killed those 12 children. With all of that going on, Pippa Stevens joins us with more on finally a big move in oil, and that you wonder if markets are starting to get more concerned about.
All right, so let's talk about these concerns right now. Market is expecting that September rate cut. That's what we're looking for. September rate cut. Let's throw on the charts on YouTube. You guys can see it on TikTok over there. So here's what we got so far. I'm going to widen this out a little bit for the YouTube. Okay. Here we go. So markets are looking for that September rate cut right away. We had interest rates rise after the report that the Fed will not be cutting. Now they have a report. They have a written report. And in the written report, the Fed basically said, we're not serving up a September rate cut, right? There was no language that said, hey, we're looking to cut in September. The only change is they're looking at recession and inflation risks as a balanced risk. Therefore, they're a little more dovish. They're actually a little more dovish. They're a little more to the they're not going to hike rates, but they're a little more to the cut side, right? They're going to be cutting. They don't want to signal that right now. So the market actually read that, I think, and initially dumped, but the market is now saying, hey, okay, they're not, they didn't signal up a September rate cut, but they also mentioned that they're going to be a little more dovish going forward. And I think what we got to realize is today might be the meeting for July, right? The July meeting, but in August, they don't have another meeting until September, but in August, there is a Jackson Hole meeting, right? The Jackson Hole Big Fed meeting. And I think that's where they're going to serve up rate cuts for September. Right now, unemployment is at unemployment's pretty high. Unemployment's at 4.2. The SOM rule is starting to trigger. If we go up one more point, which we get on Friday, you go up one more point. We're at 4.1%. We go to 4.2. The SOM rule now triggers. Once the SOM rule triggers, that's another variable that gets the Fed to say, okay, we're going to lose labor, right? We're going to lose the employment part of the economy. And if you lose the employment part, which we probably won't get, you have a lot of fiscal policy coming online. You have a lot of printing, whether it's, Harris or Trump, they're both going to send out stimulus checks if something gets too bad. So we're not worried about that, but the market definitely is pricing in rate cuts for September, right? So if we look at IWM, the small cap index, that index has been the big rotation. This has been the giant VIX rotation. When I say the VIX rotation, we have T-minus 1 minute, and then Powell's going to be on. We'll switch to Powell. Small caps are right now bidding higher. All right, so we have small caps in a bull market because they are interest rate sensitive, very interest rate sensitive. They've been outpacing NASDAQ and the S&P. Probably had like a 30% rally. We had a big 30% rally with the VIX climbing at the same time, right? We have the VIX going up to 20. Now, long-term average for the VIX is 20. We're looking at the 20 level. You typically, markets bottom when the VIX peaks at 20 when we've been trending below the VIX for a while. We've been trending below the VIX, and we're looking for that touch. Well, we had it back a couple days, so maybe volatility is going to ease back to the 15s. I'm looking for a bounce at 15, right? Because we still have earnings. We still have the Friday employment report. Friday will be the most important report. If the employment report comes out strong, the market might freak out. The market wants to see weaker employment, weaker growth, right? Nothing recessionary, but a little more weaker growth, weaker employment. And obviously big tech earnings, CapEx spend from Microsoft, Amazon, Google, Meta. It wants to see the CapEx, but either way, volatility is up. Once we get below 50, just as a signal, once you go below 15, right? Once we get below 15 for the VIX, the market is now calming down. The confidence is coming right back into the market. I don't expect we see this until September, right? We might be trading sideways or down going forward. S&P is trying to break out at the moment. Okay, we're trying to break out at the moment. I know this isn't the clearest chart, but we are trying to break out. So we'll see how that plays out. Obviously, the Fed meeting is going to be important. We have the employment report. We have big tech earnings coming up. Home builders are in a bull market at the moment. Hi, Dorian Jervine. Home builders are in a big bull market right now. ITB, if you look at ITB, we'll go to those. Let me see. ITB going straight up, right? You have ITB going straight up, which is one of the home builder indexes. You also have, obviously, like we said, IWM. You have KRE. These are, banks are getting the biggest bid right now, regional banks, because of their interest margins. If the Fed cuts in September, the market is pricing in higher interest margins, right? Net interest margins is how they calculate it. And that means they will be increasing their earnings and profit. So banks are going higher also. The Qs are still weak, right? Qs are still weak. And I think we have to really watch this level for the Qs. If you want to short the Qs, look for the Qs to get stuck between 473. We're almost there, 473. And this will be the next couple days. 473 and about 480, somewhere in this area. If the Qs show a lot of resistance, we're probably rolling over, going to make another, probably going for a new low, heading for a new low on the Qs. I look at the RSI, and the RSI is trying to bounce at the moment, but we could definitely dump one more time, because when you go to the weekly is going to be the complete reset. We haven't actually reset to 50%, right? We're not at a full reset for the VIX. For the RSI, for the buying pressure. We don't really need to go down there, but I think we're going to retest those levels. I think we're going to retest these levels if the Fed pitches something the market is not expecting. It's all about surprise. Is Powell going to surprise the market? If he does surprise the market's going to be upset. We're listening for questions about the September rate cut. Everything's going to be about, are you cutting in September? Are you cutting in September? What are you looking at? And then he's going to say, we're looking at employment. We're looking at the data. So everything's going to come down to the September rate cut. Here comes Powell. We are going to now stream this live. All right, let's go. I guess he's not there yet. Well, we'll listen. He should be walking up.
Advisors, chief economist, creator. Oh, we have the same kind of wardrobe vibes too. Creator of the SOM rule, the recession indicator. She was among the 3 members of our mock Fed panel who voted for a cut this month. I was just reading your latest.
And reduced over the past 2 years, but remains somewhat above our longer run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina Smiley from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings for inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter and services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. The labor market and maximum employment is one, stable prices is another. So we weigh those 2 things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those 2 things are working together, and we're factoring those both into our policy.
Yes.
Chris Rugaber, Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we would have intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Kobe's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market. And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this, we raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress in the labor market, as I think, unemployment was in the mid threes. So it's a different economy. And I think that it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we've had this really significant decline in inflation and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1/4 of that. We had 7 months of low inflation. You got 1/4 of this. I would say the quality of this is higher, and it's good, but so far it's only 1/4. So I think we need to see more to know that to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
And if we're to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months were reporting too low inflation. If you smooth it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably under 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away. And you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off. And labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk basically with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how's that affecting the outlook and how's it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in and so much happening between now and the September meeting, and we'll make a judgment.
Thank you, Mr. Chairman. Edward Lawrence, the Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully, to your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got another quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee, but it's a conversation that we had today, certainly.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction. Whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate sensitive, interest sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. You're just to make it clear, it's a very difficult, challenging judgment, and we didn't want to go too soon. We don't want to go too late. But this is how we made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more, it starts to show signs that it's more than that, then we're well positioned to respond.
Is there a reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples. So it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve for starters. So many pieces of received wisdom just haven't worked. And it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown of the economy and the resulting supply problems in the face of admittedly very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Mayor.
Thank you, Chair Powell. Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those
run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. You know, we're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. We talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right. In most cases, people, if they feel heard, that their decisions are given serious consideration. For most people, most of the time, that's going to be enough. There are dissents. That's fine.
M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table?
You know, I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, you know, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go around. And then this morning we have the monetary policy go around. And I think in people's economic go around and in their monetary policy go around, people express their views about this. And there, you know, there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so, in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and you know. But I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examine the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off anymore for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market. So that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, when you're saying you're going to be data driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. So
I think it's work that we need to be doing which could be very beneficial down the road, but we don't have on a CBDC, we don't have any plan we would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
And welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. Fed Chair Powell wrapping up his news conference there. Stocks already up sharply before the decision, adding to those gains. The market clearly believing the Fed is teeing up rate cuts in the months ahead. You can take a look here. NASDAQ is, for one, the place to start looking because it's up better than 3%. That is the best day for the NASDAQ since February of 2023. But stocks are up sharply across the board. The money lines here from the Fed chair pretty clear, too. When asked directly about a cut coming in September, Chair Powell said, quote, "There's a broad sense that the economy is moving closer to the point where it would be appropriate to reduce the policy rate. On cuts in September could be on the table as soon as the next meeting." He said that they've gained a greater confidence that inflation is moving closer to target. They do want to see more, doesn't want to see much more weakening in the labor market, simply thinks that it is normalizing right now and not getting any worse than that. So with that, let's welcome in exclusively Jeffrey Gundlach. He's the CEO and CIO and founder of Double Line Capital. Jeffrey, welcome back. It's good to have you as always.
Yeah, good to be back on Fed Day, Scott.
Yep. Your reaction to what you just heard?
Well, you kind of stole it a little bit. I said, usually in these post-Fed press conference appearances, I have a kind of a word of the press conference, and the word of this press conference is could. It could, he said it's
Mute us. Okay, we're unmute now. All right, there we go. All right. So nothing too surprising. Nothing too surprising. S&P is obviously up at the moment. This is S&P 500 break, trying to get out of this zone that it's been consolidating over the last the last week or two. Right? We're coming into that anchored VWAP at the moment. I'm going to go ahead and hide this. Well, I'm going to hide the watermark. I'll just tell you what we're looking at here. So, yeah, it looks like tech is starting to rebound a little bit. We still have tech earnings coming up, but I think the takeaway here is Powell's focused on employment. Everybody's wondering, are we going to get rate cuts? Are rate cuts going to come in September? What are the chances? What are the probabilities that we see rate cuts? And Powell is not, he's kind of tossing it up for September, but he is letting us know it's all going to be about Friday. This Friday's employment report. Will we see continued slowing in the employment report, right? The jobs market, payrolls, the unemployment rate. Some people asked about the SOM rule, which is the 3-month moving average of unemployment. It's already hitting, I think 4.5%. 4.5% is typically a recession, right? You've moved 50 basis points from the low, and employment is a backwards looking data point. Therefore, we should be seeing unemployment continuously climb. It doesn't stop just because he cuts rates. It's going to continue to climb probably for 2 more months. Those rate cuts will not stop the unemployment rate moving higher initially. It'll take 3 months. It'll take time. So if he sees cooling employment on Friday, this Friday, then we could see rate cuts. He also said he wants to see inflation, same thing, same narrative as always. He wants to see the inflation data also cool. And that comes Friday, I believe. What did I have in there? Friday, not August 2nd. Should be the Wednesday. I'm sorry. Wednesday, August 14th is the inflation report. So you got 2 weeks in between these two reports before he cuts. Also, in August, we have the Jackson Hole meeting, right? There's another Fed meeting that is not here. It's at Jackson Hole. So I'm guessing if we do get the weak and cooling employment report and we get inflation cooling on the 14th, he's probably going to toss up that rate cut in September, right? He'll do that in the middle of August. And at the moment, we see Certain sectors going higher. We have regional banks, home builders, industrials, and small caps all bidding up. This is S&P at the moment, but we're going to take a look at all these other stocks moving up. I think the highlight right now, though, is, yeah, we're getting a little push on the S&P, but I think the highlight is small caps. Okay, the S&P is trying to get above. Let me take these off. The anchored VWAP from the highs. So let's move this anchored VWAP up here, SPY. And it is currently retesting the volume from the initial sell-off, right? We're above that level. This is we're either going to roll over and come back and retest the lows down here, or this is it. Or this is it. What are the chances? I think we need to see employment on Friday, and we need to see inflation going forward. We could just bid up if earnings are solid. Microsoft had kind of weak cloud growth, but they are spending like a monster. So small caps at the moment are bidding higher for one specific reason, because rate cuts increase margins and profits, and the trade is very, very this is very under-owned name. You can see small caps haven't been to all-time high since November of 2021. So we've been here for almost 3 years below the all-time high when it comes to small caps. Almost 3 years, right? Looking on the weekly chart, let's look at the RSI, where we're headed. Well, we're starting to accelerate, right? We're starting to accelerate, and I think IWM has a 30% short interest, so the squeeze will probably continue going forward into September. This is being led by regional banks. The ETF for regional banks is KRE, right? KRE has been on a tear lately. There's a lot of small little regional banks that we can look at that are leading that index if we go to the financials. And these are not big banks. We're talking about small regional banks. Let me fix this. A lot of people are not really interested in regional banks. Some of you might, but KRE is your best, is basically just the index for that. So New York Community Bank, really not catching the bid yet. This is the bank that failed last year in March of 2023. Okay, we got another bank here. I don't know who this is. Banco ZK starting to head up. Okay, and then we have Citizens Financial. So you can see the regional banks are really starting to pick up some momentum here. They might rest. They might not, right? They might not rest. That rotation in the Qs should continue. So if we have the Qs stall up, QQQ, if we have the Q stall here, right? And we're coming into, I mean, I want to see the RSI fully reset to the middle. I want to see it fully reset to the middle. Will it happen? No, there's no guarantees here, but the Qs are still on trend. The Qs are very much on trend, pretty much a buying opportunity. Is it today? Is it today? I don't know. We have earnings going forward, right? But we do know is if the Qs consolidate in this range and they do not break out, then I'm expecting those regional banks to continue to pick up steam, right? Look at the Qs. We need to get above 475 for the Qs. Couldn't do it today. Maybe by Friday. We'll see. Either way, regional banks are catching a bid. Look at this bank exploding, right? And I'm not going to get exposure to any of these single banks, but just check out KRE. KRE is your index. It has tremendous short flow. I think it's one of the most shorted ETFs in the entire market. Yes, it's a little over accelerated, but this move can continue, especially if the market believes that the Fed is going to continue cutting rates. Our second sector that is on fire is home builders, right? We're going to go to home builders. It's kind of real estate, not all real estate. If we go to the realtors, they're kind of rebounding, but not 100%. This is Realty Income Corporation. I want to see the home builders themselves. Wells, this is Welltower. I don't think that's a home builder. We'll see. Home builders. Oh, ITB is your ETF for home builders. ITB, not on here. ITB, here we go. Right. ITB breaking out to all-time highs. Why? Because interest rate sensitive sector is going to be home builders. They are, now that rates are coming down, the 10-year and the 30-year mortgage rates are coming down pretty far. The 2-year is really starting to tank. The 2-year rate, we're starting to get financing kick back in. This is all financing, right? They're able to lower their financing costs, margins go up, and now we have home builders starting to pick up there, right? When I say the 2-year rate, we'll go to the 2-year, just so you know, a little bit of education here. Let's go to that 2-year rate. It is down here, right? And remember, most businesses finance at 2 years, right? They're financing their wages, they're financing labor costs, they're financing materials, whatever it is. The 2-year interest rate is tanking, right? So what does that do for ITB? That increases their revenues. They can now finance. They can start borrowing again. You're going to see volume start to pick up. So what are some stocks that are inside the home builders that are doing really well? I got a list for you here. All right. Home builders, real estate. I kind of have them both together, home builders and real estate. But here are the top stocks. KB Homes, right? And again, this one's overheated. KB Homes is a little overheated. I want to see it pull back, but it is on fire. If we come back, all-time highs, KB Homes in a strong uptrend. You want to see a pullback at some point, right? Maybe it's not there. Who knows? Maybe it's a little closer to a moving average. I'm not sure where it's going to be, but we should see. Let's check where that moving average is at. We do have momentum. Let's check the 10-week. We're going to do the 10-week moving average. This is a momentum indicator. Okay, we're pretty overheated. It's overheated, but we're in an uptrend. Home builders, right? Next one, Home Depot. Why Home Depot? Because people are refinancing their homes. Pending home sales came out today. Hottest read of the year for pending home sales. Those are home sales. Those are people waiting to sell their existing homes. The contracts are there and they have not moved, but they're waiting to move. So you see a strong uptrend here in Home Depot, right? Lowe's probably looks exactly the same. Home Depot, this one looks a lot better. It's not overheated yet, but you're getting Home Depot bid up because financing costs are coming down. 30-year mortgages are coming down, and we're expecting the Fed to cut rates and the supply of homes to pick up and more people to start moving. Lowe's, same chart. Lowe's looks exactly the same. Okay, we're looking at Lowe's. Lennar, home builder, new highs, right? Right off that 10-day moving average, 10-week moving average, my bad, in blue, 10-week moving average. This isn't an uptrend, but it's a little more overheated than the other names. So this is not my favorite, but if it does come back, right, you want to get into this trend. You want to see it hold the momentum, okay? How about DR Horton making new highs, right? This is all part of the home builder complex making new highs. Maybe a retest of this all-time high, right? Maybe you want to see a retest here at 166. How about Builder? This is the one I do like, right? It's not overheated yet. It's down here. The RSI is starting to pick up. It's starting to roll up. And it's in a strong uptrend. We're in a very strong uptrend at this point. So I like BLDR, ticker symbol BLDR. Who is this? Builders First Source. Home builders on fire. We'll look at a couple more home builders. Just want to show you the home builders are up because financing costs are expected to come down. The Fed is tossing up. This one looks nice. The Fed is tossing up rate cuts. Here's another one. You can check these out. I'm on YouTube live, TikTok, so you can go back and look at the tickers if you want. Tickers are up here in the left-hand corner. You can't see it on TikTok, but you'll be able to see it on you'll be able to see it if you go to the YouTube channel, link in the description. Redfin. And we talked about this. Subscribe to the newsletter. I talked about this last week. Sent out a newsletter. So the Fed is going to toss up a September rate cut. Here are the charts. Here are the sectors. It's all there for you. If you want to read the macro newsletter, it is free. Okay. Here we got Redfin data. Okay. Redfin is not necessarily a home builder, but they are trying to bounce. This stock is extremely oversold and it's starting to pick up momentum. Very sharp rally if it does continue. If the Fed cut rates, it probably takes off, right? You got Redfin, you got Open Door, also very compressed, right? It's subdued. It hasn't made a move in a long time. I'm not too interested in Open Door, but Open Door doesn't look too bad, right? Wouldn't do options on that. How about Zillow? These stocks are gaining momentum, but it is the home builders that have the most momentum. Okay, next we're going to move on to industrials. I like this. Industrial stocks. The ETF is XLI. XLI, industrial stocks. Why? Because if the banks can now start financing at lower rates, if the banks' margins are going up because their cost of borrowing is lower on the 2-year because the Fed is cutting rates, they're going to make more deals, they're going to create more loans with who? With the home builders. What do the home builders do? They go finance their costs. They're going to go buy materials and they're going to start. And now the industrial stocks who build most of the goods are starting to bid up because they're expecting revenues to pick up. All the Qs, all that rotation from the Qs is coming into home builders, regional banks, small caps, and industrial stocks, right? And industrials. Let me go to the industrial complex here. All right. Deere, Deere's okay. I like Caterpillar though. Okay. Pay attention here. I got long Caterpillar this morning. Call credit spread. I think I'm aiming for like 420 by September 20th. Caterpillar starting to bid up. It's holding that 10-week moving average, breaking out of a falling wedge, right? This is a strong uptrend. Let's look a little deeper. I like the technicals here. I want to look a little deeper. Where is my support at on this stock? Okay. right here. We have support at about 340-ish, somewhere around 340. So we got Caterpillar. This is one of my favorite names. They have contracts in China, probably the most prominent home builder stock, or not home builder, industrial stock. Okay. So I see as a pattern, right? We'll take a look at this. I see a reverse head and shoulders here also. Here's your shoulder, here's your head, and we're starting to build that second shoulder. It might take a couple of weeks. Who knows? Either way, you're getting that. Once you break this trend, you get above 350 off to the races. So you have a nice trend there. That's probably my favorite one. FedEx, not so much. I don't really like FedEx. Not a fan. UPS, these are all industrials. UPS looks like trash. Boeing, I believe, is trying to break out. I'm not a fan of Boeing either, but they might be doing well. This is a rail company, Union Pacific Rail, another industrial stocks. Well, when you start moving big machinery and industrial, when you start moving big machinery around, you have to use rail, right? So there's a lot of rail coming in because the economy is starting to accelerate. The industrial manufacturing economy is starting to accelerate. So I'd put Union Pacific and Caterpillar up there. I like those better. MP Materials, not necessarily. Nope, don't like that one. How about Honeywell? Okay, so Honeywell is pulling back. That might be a buy. It's overcooled here. You want to see it rotate up, but you definitely have that one. I still like Caterpillar the best. Who else we got? Pave. Okay, here we go. I think the trade RTX, I have no clue who this is. It looks like they are also aerospace defense. Okay. Data processing. Wow, this thing spiked. Okay, this one spiked a little bit. GE trying to break out, but I don't like these. I like Caterpillar. Let's go on to IWM because IWM is the small cap index. And if you want to triple leverage, I think there's a triple leverage. It's TNS. What is it? T and something. Anybody know what it is? The triple leveraged IWM ETF? Not sure. I don't remember. I think it's let me see. TNX. Is it TNX? No, this is a 10-year treasury. It's TNS. No, Thong. No clue what that is. All right, we'll go back to IWM. Right, IWM. Really starting to break this resistance. So, okay. So this is where all the alphas coming into. Small caps, regional banks, industrial stocks that their earnings have been depressed a lot, right? Very depressed earnings. So they're starting to pick up now. Now, also we look at the Qs. Where are the Qs at? Can they bid up? I'm looking at AMD. I'm long AMD at the moment. Had a nice bid in the morning, sold off. Where is the bottom for AMD? Well, it is down a lot, right? AMD is down, what, 50%? Okay, so when we do get the recovery, usually semiconductors don't bottom until October. They start to show. So you might want to look a little further out if you're buying calls, if you hedge, whatever you want to do. But I think that AMD and the chips are starting to bottom. But I like AMD the best because it's been selling off the most. You can see down here, the RSI is reset, right? On the daily, at least, it's reset to extremely oversold. It's overcooled. That gives you the best probability of upside because it's already down. Okay. I'm gonna go to the in-play stocks that I have out here. It's pretty much the same thing. I'm short Walmart. I've been short Walmart for a while. Some of you guys know if you were paying attention, but I've been short Walmart. I don't really care about Walmart. I think it's up way too much. Piece of trash. TLT also, right? Keep out for bonds. The bond market might also break out. Okay, looking for the bond market to break out. Ticker symbol TLT. Now, yes, the 2 years coming down, but the 10-year is also should be coming up at the same time, right? The 10-year bonds, people are buying those bonds because the economy is slowing, the labor market's coming down, inflation's coming down. TNAD is a 3x ref. Okay, TNAD. Is it TNAD? I don't have that. It doesn't show up on here. TNAD. It's T something. I'm not sure what it is. Okay, Elf Beauty. Elf Beauty. There's never a recession in cosmetics. Never has a recession, right? Looks really good. This thing's been up a lot the past year. It is forming. It's at the bottom of this channel. Well, yeah, pretty much coming into the channel. Pretty oversold, starting to pick up momentum. This is what I like to see, the momentum really start to pick up. So we have Elf Beauty also. Will they get hurt? Maybe, maybe not. People typically spend a lot on this. Okay, you have Celsius. Celsius is down tremendously. This is not a home builder. This is not part of the stack. but Celsius is down tremendously. It's down 50%. Okay. And it is trying to bottom out here. You can see the RSI has been extremely oversold. I don't think it drops any lower than 40. Maybe it does if it has a bad earnings report. Might want to wait for the earnings to come out. But Celsius is oversold. It's part of the small cap industry, though, right? It's in the small caps. So even if IWM breaks out, it should give it a little bump higher. KRE, we just went over it. KRE is short squeezing. This is why it's going straight up. It's a complete short squeeze. This is the regional banks right here. Ticker symbol KRE. ITB, already talked about it, exploding because financing is coming down. Home builders are starting to catch a bid. BLD went over that. Copper, okay? I think copper is starting to bottom. This is Southern Copper Corporation. All right. Copper in general, watch, we'll go to the copper index and then we'll come back here. I think I could just say copper. Let's see. Let's go copper. All right, here we go. All right. Copper is extremely oversold and it is finally starting to bounce. Let's measure this drawdown. Big drawdown for copper, down 21%. Okay. It's oversold, and I think the long-term trend is picking up. We'll go to the weekly. Okay. Weekly, it is finding support at the I believe this is the 200 weekly moving average. Let me double check. Oh no, this is the 50-day. Okay, this is the 50-day. I'm sorry, 50-week moving average. We're bottoming at the 50-week moving average. So if you have copper bottoming, now I don't have copper. I don't have exposure to copper, but I will get the company, Southern Copper Corporation. I think it's SCCO. Okay, got it back on here. I'm expecting this, and it's a nice little wedge pattern. You know, it's consolidating a bit, but I also went long this morning. Not financial advice, but I do like copper. I think it'll be up a lot. You know, I think it'll be up much higher in the next couple months. So this is another one, Caterpillar, copper, like those. Another copper miner here in an uptrend. You have Freeport-McMoRan. Okay, up a lot. Same thing, but I like Southern Copper a little better, right? Now we're going to move on to the mega caps, right? What do we have from NVIDIA? Not NVIDIA, I'm sorry, Amazon, Microsoft. Their data spend, their capital, their AI spend is ridiculous. It's absolutely ridiculous. And Amazon reported they're spending a lot on AI. Meta reported a lot on AI. Google, same thing, right? So what do we have here? We have a correlation with utilities, right? XLU is going to be your utilities. And look at that bid. Nice pattern. XLU is the utilities ETF that you want to look at. So do I want to trade utility straight up? No, I don't really want. I want to go find the best company. I want to find the company with the most momentum. And what I like to see, okay, I find the utilities. I want to go to CEG, Constellation, Energy, right? After who reported yesterday? Who was it? After Microsoft reported it, can't even talk. After Microsoft reported, CEG exploded in after hours because they are directly they're the direct beneficiary of all these data centers going up. And CEG is over in Virginia, right? Virginia has the most data centers in the US at the moment. So they're going to benefit from all the electricity costs, right? This is a bid on electricity. They're benefiting from all the electricity as a fundamental play. So I've been long CEG for a while, about 2 weeks now, and I'm just waiting for the data center spend to come on. Hey, maybe Apple's overbought all these other companies, but guess what? They're spending on data centers and electricity, and I expect CEG to benefit from that. So this is a utilities play, right? This is the great rotation that we're starting to see out of tech. Now, remember, when it comes to IWM, the entire index is 9 trillion, the entire index. Well, guess what? NVIDIA, Apple, and Microsoft are 9 trillion by themselves. So a small rotation out of tech into the small caps is a big move to the upside. That's why I'm interested in seeing this. It has a lot more momentum going forward. CrowdStrike, extremely oversold. This is going to be a hard one to catch the bottom, but you're getting near the bottom. I think it bottoms before earnings. August 27th are going to be earnings. I think it bottoms before earnings. It's extremely oversold. So if let's go to the weekly. I'm waiting for this weekly to reset all the way down to the blue line, which is oversold, overcooled, right? It's overcooled. It's too cool. It's frozen. Investors will probably come in and scoop it up. It's not like the business is falling apart. They're getting sued by a couple other companies for the mistake. But either way, this will bottom out, right? This will bottom out. This is probably the top cybersecurity company anyway. So CrowdStrike, keep an eye on that. I don't think it's bottomed yet, but I would pay attention there. Okay. CMG, Chipotle, extremely oversold. Why? Because I believe Chipotle was lowering prices. Their margins are coming down. So they started selling off. And this thing sold off a lot right after they did the stock split. But you can see we're starting to get a bounce. We have 3 days in a row of green, right? So Chipotle starting to look good. I want to see a small consolidation or a pullback. I can see the reverse head and shoulders starting to form for Chipotle. And once it starts to clear this level, 55, once it starts to clear about 55, I think it's in play. So I'm watching Chipotle also. Robinhood, we'll see. I love this play on Robinhood. It's a play on crypto. User trades are going up. I mean, we're literally trading on Robinhood. Yes, reverse head and shoulders, Monkus finds, reverse head and shoulders, 100%. What concept is that? What concept is that? I'm not sure. Oh, you're talking about can you be a little more specific? Not sure what you meant. If you're talking about the reverse head and shoulders, then it's just a technical pattern. It's a technical pattern. I have patterns on the website. If you want to go check out technical analysis, you can go look at it through the link on my bio. If you want to see some technicals, you got to just search for technical analysis. Reverse head and shoulders, yes. I'm running against Meta today. Okay. All right. So the two crypto plays, Hood and Coin. Okay, Hood and Coin. Now remember, these things will explode. I think still the biggest rally coming is not just small caps. I think it's going to be crypto, small caps, bonds, utilities from the AI play. Bitcoin's not doing much at the moment, but I still, Bitcoin is getting close. Once we get closer to the election, as Trump leads in the polls, right? If Trump leads in the polls, crypto's going up regardless. But if Trump leads in the polls, I'm expecting a bid to come up because of pro-regulation, friendly regulation, and the potential to put Bitcoin as a treasury asset. Who knows if it actually happens? Either way, they're now considering it, and that's very bullish. You have the Ethereum ETF. Ethereum is consolidating, waiting for a big move. When Ethereum moves, it moves. I'm expecting it to move to about 5,000 pretty quickly when the move does come. Okay, for Ethereum. Also, we're looking at Chainlink, who partnered with Fidelity, who's partnered with Swift, who's partnered with DTCC. Is this not on the log? Put this on the log. There we go. Right. So I like Chainlink also. My favorite crypto play at the moment. Tesla, not ready yet. Still waiting for Tesla to consolidate a little longer. Broke down. But those are the plays that we're looking at the moment. Small caps, industrials, financials, but not all financials, mostly regional banks. Home builders are hot though. You want to wait for that pullback on home builders, small caps in general. You have utilities and you have copper. Those are all the plays. No, you're good. All right. So yeah, that's what we're looking at. Now for the macro stuff. What are our macro indicators? What is the macro telling us about the market? What is the market reading? The macro forces, what are they telling us after this Fed meeting? First, let's take a look at oil. This is the cost of energy. Okay, this is very important. This is a macro force. If energy is too high, inflation expectations come back. If oil ever spikes, I don't think it does. Summer months are over. If oil ever spikes, that could kick the recession into play because now your inflation goes up a bit. Input costs for all the companies go up. I think it's dead though. I think oil is done. There's no way it's going higher. The war is pretty much coming to an end. And the summertime rally. Oh, TNA. There we go. TNA. I knew it. Thank you, Carbides. 10-year yields. This is the bond market. Okay. The bond market is what prices the cost of financing. This is basically the cost of financing for companies, right? The 10-year, at least 10 years out. Long-term risk assets, all price on the bond, on the bond yields. These are bond rates or interest rates for the market, not interest rates for your credit card. And bond yields are making new lows. We're continuously making new lows, pricing in rate cuts. The market is pricing in rate cuts. Weaker costs are going to cause a bid in pretty much everything, right? But the most sensitive bid is going to be in industrial, small caps, regional banks until that rotation completely takes over. How about the dollar? This is going to kick off crypto in my view. Once the dollar breaks, the market is anticipating quantitative easing. That's what rate cuts are, right? It's not complete quantitative easing, but rate cuts are definitely increasing collateral in the system. You cut rates, now people can leverage even more, right? Not just people, but now companies can leverage more, and their cost to run the business, their operational costs come down. So I'm waiting for the dollar to break. And once the dollar breaks, I think the crypto bull market, mark my words, the crypto bull market kicks off. It's all coming together when the dollar starts to break under this level, right? If we get under 103, it's on like Donkey Kong. But for now, we're just waiting for the dollar to start trend, continuously trend lower. I don't see anything kicking the dollar higher. The dollar is a risk off asset, and it is risk on at the moment. We might have one more sell off on the Qs, but it is risk off. So yield screaming lower, right? Lower financing cost. That is economic expansion. Energy is still consolidating. Nothing too crazy. It's kind of dead at the moment. Nothing too crazy. I'm not long. I'm expecting gold to pick up. Why? Because, well, interest rates are coming in, and gold is a monetary hedge against monetary inflation. You cut interest rates, people start borrowing more. You debase the currency. Gold goes higher. Bitcoin goes higher. And store of value assets go higher. Okay. What else we got here? I think we covered pretty much anything. We got any questions from the Fed meeting? TNA is going to be the 3x bull. Thank you. This is a 3x leveraged small cap index right here. I think there's some 70 calls. There's some like October. I'd be looking at October 70 calls just to give yourself some time. I'm looking at October 70 calls, and this thing has a long way to go. You can do a call credit spread also to cap your risk. That's how I would do it. You're taking very, very small amounts of risk here. So, 3x leverage small caps. Do not have a short. Make sure your time horizon is a little longer. Probably trade up to 68, 70 pretty quickly. So we're heading into what? August. We're now in August. The most volume usually comes in August. Let's look at the trends here. Let me look at the trading trends for S&P 500 price action. Let's go to volume. Here we go. We're going to use Edgefool to look at the volume. Volume trends. Here we go. Last 5 years? It doesn't look that strong. Well, July historically has low volume, so volume should pick up in August. Do we get another sell-off? Maybe. This is what I'm looking for. This is all upside. We've been talking about the bull case, right? Let's go to the bear case. Bear case is the RSI has not fully reset. What is that? Just buying pressure, right? You might need a bigger flush for tech. We still have earnings coming up. We might need a bigger flush. If that bigger flush comes, I'm watching the Qs to flush the most because there's so much capital that still wants to come out of the Qs. And the Qs need to get above this previous level. Our previous level is 475. You get above 475, I'm pretty bullish if we hold 475. If we get stuck here tomorrow, Thursday, Friday, and start showing bearishness, I'm probably going to get short like the 590s, 590 puts, right? Well, I'll do a call credit spread. I'll do a bearish credit spread, but I'm probably going to get bearish here. We're a little overheated on the RSI on the 30-minute, but that's irrelevant. I want to see it get a little more overheated. Ooh, the hourly is a little overheated too, right? Not completely. We are in a high vol environment at the moment, so that doesn't mean much. Here we go. This is what I want to see. I want to see the 4-hour chart get overheated. It's not there yet. We might have a couple more moves. We might consolidate into this level, but definitely 475. Maybe it breaks out, gets all the way to 480, right? But this is the zone. This is the zone that if the Qs cannot rise above, it's probably going to come right back down and make one more low. I'm thinking it's going to triple bottom around 450. Okay, I'm waiting for that triple bottom around 450. Maybe, maybe not. We'll see. But it is trying to break the trend. It's trying to break the downtrend at the moment. And we have more resistance if we use anchored VWAP. Where's our anchored VWAP at? Anchored VWAP, where you at? Why can I never find it? Oh, well, oh, that's weird. It's not a face. Ah, did I just go brain dead? Where's the anchored VWAP? That's what I wanted to see. All right, whatever. Whatever. We're holding anchor VWAP from the previous low, though, so I think we're looking pretty solid here. Okay. So who knows? We don't know what's going to happen, but I'm definitely looking at some bearish price action into this level, 475 to 483 over the next couple earnings report. Who's going to carry this name? Well, we have, who do we have reporting? Is it Apple? Is it Apple and Amazon, right? It looks exactly like the Qs. Okay, we got Amazon here. I think they're going to do well on earnings, but there might be one more flush. We'll see. Maybe not. Okay. Also have NVIDIA. NVIDIA trying to retrace back up from this broken pattern. So I think because this was such a solid report. I'm sorry, report. This was such a solid level around let's call it 118. Okay, let's call it 118. Such a solid level. If NVIDIA cannot climb above this level, that it's, had support for about 3 months, 3 or 4 months, like 6 months. It's been supporting this level for 6 months. It is now retesting this level on a sharp upside move. The RSI, the buying pressure starting to pick back up. But if it can't get above this level, we're below this is the 50-day moving average. That's a death cross. You got the 10-day going against the 50-day. If NVIDIA can't get above 120, for sure above 120, I think the market's going to retest the lows. I think we're going to see the Qs retest the lows. S&P not as bad. Dow definitely not as bad. The Dow looks good, which is why I'm long Caterpillar. Look, the Dow and IWM are doing pretty well, not rolling over. So that's my outlook going forward for that. Let's see what else we got. We also had the treasury issuance was lower than expected. And that tells us that the bond market, US bonds will probably go higher, right? The market's not going to have to sell bonds because they're not getting debased as fast as initially thought. Today we had unit labor cost. No, that was today we had pending home sales. We had employment cost index is down. People are coming back into the workforce. Also, if the unemployment rate on Friday doesn't go up at all, it's not bad. It's not bad, but small caps, they might struggle. They might not. At this point, it might be too late. It might just be like, hey, small caps are sniffing out. If it doesn't happen next week, it'll happen the week after that. But tech maybe does roll over, right? Now, the volatility index, the long-term average is around 20. Okay, long-term average is around 20. 20, anything above 20 is an issue for the market. Okay, anything above 20 is an issue for the market. The next level for this is going to be, and the standard deviations are about 8 points. So from 20 to 26, okay, that's a whole standard deviation. This is a gigantic move. There's no way we get up there without something nasty, right? So we're probably going to hit resistance around 20 by Friday. I think we still retest this by Friday, the 20 level on the VIX. Maybe not. Maybe we're done. And then the next level below that, which is a cooling of volatility, meaning the market is a little more comfortable where it's at. It can see the next 30 days as not as volatile, is going to be 15. So we either bounce at 15 or we move up to 20. But I think we're going to stay pretty elevated until we get rate cuts, until we know who is going to be the president, right? So we kind of can, and so the market can anticipate what are the next regulations, right? What are the next regulations? Are we going to get more mergers, acquisitions, which helps out banks because they got to do the financing? Are we going to get less deregulation? Are we going to get a tax cut, a corporate tax cut? The market really does want a corporate tax cut. The market is pricing in a Trump victory at the moment. So we'll see how volatility ends up. The election isn't till November, but I think we're going to know before that. I don't know. I mean, me personally, I think Kamala Harris doesn't stand a chance. Could be wrong, though. We could be wrong. So we got to see those polls. We want to see exactly what the polls show us going forward. So I'm looking for vol to stick around here. If you're selling options, you want to sell at the top. when vol is elevated. The premiums are juicy, but you want to look out 45 days and manage at 21 days, right? If vol comes down, maybe calls will look better because calls will be cheaper. Options will be cheaper if vol comes down. So volatility is still in the middle. It's not over yet. Now, if this was a definitive report where it was very clear things are going to be great, volatility would collapse below 15. It is not. So the market can still sell off. We might still get a retracement on the Qs. And I'm really looking at NVIDIA to see if we get that move. All right. That's all I got. We're stuck here. For the most part, the Fed is looking for the data. Friday, employment needs to be cooling. Maybe not too quick, but it needs to cool a little bit. And then we have inflation following that. And if inflation cools, it's on. Rate cuts for September. That Jackson Hole meeting, right? This is probably not on most people's calendar. The Jackson Hole meeting is a big Fed meeting. That's where they announced interest rate increases back in 2021. It was November of 2021, Jackson Hole. Let me see. Where's Jackson Hole at? Why isn't it up here on high impact? Should be high impact for Jackson Hole. August. Is it after or before? Why isn't this showing the whole month? This month. No, next month. All right, yeah, the Jackson Hole Symposium is after inflation. Okay, after inflation. It's August 21st. You get the FOMC minutes, and then you get the Jackson Hole Symposium. And it is going to be Wednesday and Friday. So that's about 3 weeks away. And I'm thinking that's when the Fed starts to signal rate cuts, unless something changes. If nothing changes, we should be getting September rate cuts. And hottest sectors, small caps, industrials, home builders, regional banks. I want to say those are more for the macro, right? Those are macro catalysts. But when you talk about the AI narrative, the catalysts are going to be utilities, copper. I think that's it. Utilities and copper, and then semiconductors are going nowhere. All right, that's it. Stay tuned. Go to the newsletter. Check out the newsletter. The latest one is in the YouTube bio. If you want to check it out, subscribe. And we are building a course, macroeconomic course, so you can think for yourself and not have to listen to me. Just education, all that stuff. It's almost done. I think the first part is almost done by August. It should be completely done. The macro portion will be done, the intro to macro, and then the analysis part comes a little after. So stay tuned for that. We will have that so you can analyze all this stuff like a pro, like an economist, right? You don't need to know every detail of the economy. You just need to know what moves markets, right? That's what the course is about. What moves markets? It's not technicals. Technicals tell you what's happening, but the macro moves markets, right? Changes in interest rates, money supply, credit, changes in fiscal policy, changes, and then reading the economic cycle. Where is growth? Right now, industrial growth is starting to pick up. Industrial production is picking up. That is growth underneath the hood, but a lot of indicators are in recession. Real estate's in recession, but it is starting to pick up a bit, barely, right? Only because interest rates are coming down. So we'll see. All right, you guys stay blessed, work out, learn something new, eat healthy, and good luck. Good luck to you. I think we will be back Friday. Maybe I have some people visiting, but either way, we'll do another report and see, how's the market going to respond. Maybe do earnings tomorrow. We'll see what happens. Good luck. Can't hear. You can't hear? No way. Oh, that was old. Okay. All right, guys. Appreciate it. Stay blessed, and we'll catch you next time.